I might have a fair idea. We shall see. I wonder what the fundamentals are doing for us. And to round all of that up, let's say a very, very good evening to Lexi. Hi, Lexi.
Hi, Jeff.
How are you, mate?
Doing great. All right. Yep. Really,
What's going on?
it was a really interesting Thursday. So I'm going to share something a bit more to do with the bonds, because when we have inflation and interest rate moves, they are pretty much almost always kind of related to the way the bond market moves as well. So let's just pop on to it. And I think the past couple of weeks, we have been talking about what we call the interest rate, the bond yield curve. All right. So we're going to look a little bit at the bond yield curve. So this is on Market Watch. We're looking at the 10-year Treasury note. You can see that let me try to zoom in a little bit. I'm just using a 1-year chart to kind of show you guys there's this drop in the bond, a sudden drop in the yields over here. I guess one way we can kind of look at it, right? I'm going to show you guys the dollar yen. So the dollar yen, we have been long the dollar yen for quite some time. But the really interesting thing is, the dollar yen and the yield curve for the 10-year yields are pretty, I wouldn't say very correlated, but almost quite. You can see that the orange line is the US 10-year yields. So it's not the bond prices, it's the yields. You can see that usually when the 10-year yields start dropping, you can see that there's a very aggressive selling off on the dollar as well. So across the board, most of the currency pairs, all right, we have that dip in the yield, and then that fall in the US dollar. So it's I'm just overlaying the 10-year yield curve against the dollar pairs. All right, and of course, if you look at the euro dollar, it will be the opposite direction. All right, the yield goes down, and it leads the general weakness of the dollar as well. So I think one thing interesting about looking at the yield curves is that according to, I think what I'm going to layer on what Gordon said about the inflation rates. So if we look at the inflation rates, right, let's just see what exactly were the changes. All right. So if we look at inflation over here, basically what happened is the inflation actually dropped by minus 0.5%. So the latest inflation, I think this is the old figure, it's actually 7.7. I think let me use Trading Economics that I didn't format it properly. So according to Trading Economics, we have the inflation down at 7.7. All right. But one thing I would like to also note is the jobless rate. So actually the previous reading, I think about 2 weeks back, we had the jobless rate coming up at 0.2 above. All right. So actually this was kind of a precursor to what possibly might be the general sentiment of the market in that sense. All right. Because there are expectations of a recession coming, expectations because people are looking at the inverted yield curve, and we are still having kind of high inflation. Plus, you can see the past couple of readings, employment is trying to pop towards the upside. So what we're looking at is a little bit of a indicators of slowdown of the economy. So the GDP figures, the unemployment figures, as well as the inflation figures, they're all a little bit, I would say, lagging. So what we're trying to, what I guess the traders and investors are doing is they're trying to forecast what's coming up. If we look at, in the future markets, and whether or not, there is anything to worry about. So over here from the Treasury website, all right, you can see just the last couple of yield readings. So we have the 5-year yield, 7-year yield, 10-year, 20-year, and 30-year yield over here. So what is really interesting to note at these readings is that across the board, on the 10th of November, the 5-year yields have dropped significantly by at least, 0.2 points at least. And we have the same going on for the 7-year, the 10-year, the 20-year, the 30-year yields. Everything dropped by at least 0.2 to 0.3 points comparatively, which means something has changed over here. All right. So we had a period of very high interest rates, the 4% interest rates. We had a period of high yields where people are buying long-term bonds because, the money is just, in terms of yields, is just more attractive. So the sudden, I would say, the sudden change in inflation kind of triggered the desire for, the desire in the bond market to kind of be a little bit wary in that sense. So what I sense might be happening is because they are expecting a cool down of the market, which means which kind of correlates with what Gordon kind of said. If you kind of project I was just going to use this reference as well. If you kind of project the CPI, right? If you kind of over here, so if you kind of project the CPI times 12 to the next 12 months, you actually have inflation about maybe 4.8%. All right, but low inflation just indicates that prices are coming down. But what is the back end of this? It also means that there's something is happening to the supply and demand of goods and services, right? So one very easy way to kind of understand it is if prices are coming down, it will kind of indicate that the market is oversupplied at some sectors, or people are kind of maybe having difficulty losing their jobs, difficulty purchasing. So we're talking more about the credit and debt market, the productivity cycle, all right, and that is usually a little bit lagging. So all this whole period where interest rates were high, between 2 to 4% in the last couple of months, I think we are going to see the impact where during those months where not as much money is being borrowed, not as much credit is being used up, we are going to see that productivity cycle kind of switch towards a slowdown. So inflation figures, they are kind of, I think, about 0.2%, it means it's slowing down faster than expected. So another point to note is we could expect that at some point in the next 1 to 2 years, if the slowdown is impacting jobs, is impacting, true, you get inflation down, but if it starts to impact the productivity cycle, the employment cycle, we will be seeing the US maybe consider lowering interest rates, especially if the next reading, I would say if the next CPI reading next month again falls below their projection, then it's something I would say is going to be really a little bit more scary on the job market for the US side, which means they are going to be facing kind of a slowdown. Because if we look at the GDP figures, and again, GDP figures are lagging, is a lagging indicator. Currently, it's still at 2.6. Again, it's a very slow, very lagging indicator. But I'm again wondering, is this a temporary pop-up? Previously, we've got a negative 2 quarters of a GDP cycle. So the next 2 quarters of GDP also would be pretty important to see whether that negative GDP is coupled together with increasing unemployment, because that would be, I would guess, more of a confirmation that the US market would be sliding into recession. So how will we be trading it next month? I think for the next week, I will be a little bit cautious on the long USD. Sentiment is still a question mark. Is this a temporary pullback? I'm not too sure on that, because the moves are a little bit violent. I do believe there will be some retracement to the upside. All right, is this a change in trend? I guess on a technical point of view, I'll wait for that first lower high before I get confirmation. And also one eye out on the Fed speeches that's coming up next week. So next week, we have a couple of speeches coming up. What we kind of need to figure out is what the FOMC, the monetary policy over here, right? I think Thursday 9 p.m. there's the FOMC speech. So I think one way to kind of look at it is to keep an eye on the speeches to kind of get a sense of whether or not they are worried by the economy cooling off too fast, or are they still, or do they still plan to stick to their plan of continuing to increase interest rates at least 1 or 2 more times? All right. So at this point, 4% seems to be kind of working. Let's give it a couple of months to see whether inflation continues to pull back. If inflation goes down slower than expected, then I guess we could expect one more interest rate increase. But it looks like it's kind of undershooting in that sense, right? Which means there is going to be a high potential that the next interest rate forecast, they might not increase interest rates at all. All right, and they're just going to leave it as it is if inflation kind of crawls towards the downside. So I'm going to be very cautious going on long dollar at this point until a little bit of clarity comes out in the market. So I guess from a fundamental perspective, a change in trend looks possible, but I would like to wait for confirmation to jump in on that. Yeah, so it will be really interesting to watch the US market and the news and to see what comes up next week. That's all for me, Jeff. A little bit of caution for me next week.
you're a chicken just like the rest of us, right?
Yes.
You're not prepared to call it, and nor am I. There's definitely not. I mean, you can't on two candles, you can't
Yeah.
just say, okay, this entire trend, which has lasted so long, is about to end. It's do we want to see it end? Well, if you're a self-retiree,
Yeah, precisely. I mean, it's just one
you probably
CPI figure on candles.
Yeah,
Yeah.
exactly. Can it waterfall from here? Of course it can. And has the reversal started? Maybe it has, but we don't know yet. And I think you did right. You got to wait for that lower high before you even get too excited. Maybe there's some buying opportunities. We'll see. But it's really on a seesaw right now, I believe.
Yeah, I guess I will be watching the bond market quite closely as well. So, to kind of see how the yields and the prices play out, because that will give us a kind of leading indicator into where the US dollar is going as well.
Yep. And I think it's going to be a very interesting week ahead. And if there is confirmation of that reversal, then look out. We become buyers on the stock markets, and we become sellers of the dollar. We'll see.
Yeah.
Thanks, mate. Much appreciated.
All right, cheers.
I think we'll probably stick with that theme, and with the